joining us now. You would have seen this coming if you'd been watching this program and listening to this lady, the president of Macro Mavens, Stephanie Pomboy.
Thank you so much.
You've been right all year, and you saw it coming. So what are you looking at, watching for in the new year, Stephanie?
Well, I think that a continuation of this deceleration in growth and more realization that the fundamentals weren't quite as fabulous as they were perceived to be. It's not that the fundamentals were awful. It's just that perceptions about where the economy and profits were going got so far beyond the reality that I was seeing when I dug beneath the numbers. So I think that what we're seeing is kind of a realignment, let's say, of expectations versus reality, and you're seeing that in the S&P earnings projections, which were basically a flat line sideways at 12% growth for 2019 all year, and then they started to edge down in the fourth quarter, and now we're sub 8%, and I think that number just keeps coming down, and the S&P follows it. Expectations really drive the market. So I think we're going to see a year that involves much more financial market turmoil, and I'm particularly focused, obviously, on the corporate bond market.
And you've pointed out that a move to the downside in the markets, a major sell-off. We haven't seen a full bear market close on the S&P 500 yet, but very, very close during Christmas week. But that alone can cause a recession.
Sure.
Are we there?
I don't think we're there yet, but I think we're going to get there, sadly. I think that this decline in the stock market is really just getting started, and then I worry about the unquantifiable effect as yet of all this passive trading, the algorithmic, the ETFs, and to what degree a downturn is amplified by those.
I want to get
capitulation.
I want to get Matt in here because I could hear you talking in my ear. I mean, I could hear you because Matt, the Journal, has written about these very things.
I want to hear more from you on your concerns about debt, corporate debt, individual debt, which is creeping higher. Some people say that's a sign of a good economy when individual debt's going higher. We've got a lot of corporate debt coming due in 2020. Yep. How much is that going to curb spending? How worried are you about our debt levels right now?
So the consumer, obviously I worry about the weakest link in the chain, and that we've already seen problems there. Subprime autos, student loans is a whole separate topic. Credit card delinquency rates have started to edge higher. So obviously the situation isn't improving there. But I think the real froth is clearly in the corporate bond market, where you saw a massive increase in debt. We now have sort of a triple threat here, and that is we've got corporate sector that's got record amount of debt, a record share of which is low quality, and a record amount of which needs to be refinanced in the next 2 years. So that's not a good combination, especially not against a backdrop where the Fed is raising rates and taking liquidity out with quantitative tightening.
With the implication of less and less corporate investment this year, which has ramifications for the job market and all kinds of
And it feeds right back, exactly, which will hit profits, which then, will push stocks lower. But I think another feedback into the stock market from this corporate bond market turmoil is just the buyback story. I mean, it's stunning to me.
Well, this is what I was mentioning earlier, is that I didn't mean to interrupt you, but we talk about the individual investor, but it's really the corporate executives who have a lot of their net worth tied up in their own company stock or in the stock market. And so when the market sells off like it has a real impact on how they invest and how they buy back their own stock.
Well, I mean, I think that this will come out in the aftermath of the downturn, the degree to which corporate insiders announce share repurchases at the same time they're silently unloading their own positions. But that's, again, something we'll hear about later. But I think, the degree to which buybacks have provided silent support for the stock market is going to be clear in its absence. And that buyback bonanza was financed in the corporate bond market. And so as the corporate bond market starts to deteriorate, obviously the buyback situation, you think that's going to slow as well. I know in the fourth quarter we're going to see a record amount of buybacks, or at least they've announced a record amount of buybacks. We'll see how much of that actually comes to fruition. But I was looking at the numbers the other day, and you've seen non-financial corporate borrowing has increased $3.2 trillion in the post-crisis period. Buybacks, want to guess what the dollar amount of buybacks is for non-financial corporations? $3.3 trillion.
Oh, wow.
So it's not a mystery. It's, one side of the bubble, both sides of the bubble coin.
2019 then is all about deleveraging. Would that be the theme for 2019?
Yeah, I think in the corporate bond market, for sure, we're going to have to see corporate deleveraging, which will be, brought about by this tightening of credit conditions. It's not a voluntary deleveraging.